Okay, let's unpack this. We are diving into the KB Home fourth quarter and full fiscal year 2025 earnings call.
Which dropped right after the close on December 18th.
And this is one of those classic calls that just gives you whiplash, right?
It absolutely does. The tension here is you can feel it immediately. KBH posted a material beat on their headline numbers.
A big beat.
Yeah, way over consensus. But then you watch the stock, it pops for a second, and then just reverses course, ends the night lower.
So our mission is to distill that tension for you. We have to figure out how management delivered such a strong quarter and at the same time basically set off alarms with their forward guidance.
It all comes down to a strategic pivot, a really deliberate one.
A necessary one, I think. It's like they're taking some medicine now for a long-term cure, but it's causing this near-term pain in the margins.
That's a great way to put it. You're watching a management team cleaning up yesterday's mess to build a stronger foundation for tomorrow.
And investors just hate the cleanup costs.
They always do, but the strategy behind it is really compelling.
Okay, so let's start with the good news, the snapshot. On an adjusted basis, KB Home, they did really well.
They really did. Adjusted diluted earnings per share came in at $1.92.
Which flew past the consensus of, what, 179?
Yeah, blew past it.
Yeah.
And revenue was stronger than expected, too, at $1.69 billion. If you just read those two numbers, you'd think it was a total home run.
But the market just shrugged. It shrugged off the beat. Why? Because it was all about the margin pressure.
Exactly. The housing gross margin, it just declined so sharply year over year. It went from, the high 20s a year ago all the way down to 17%, or 17.8 adjusted.
That compression, that is what everyone is focused on.
That number is the fulcrum of the entire investment thesis for KBH right now. It really reflects the challenging backdrop of 2025.
Where they had to just move inventory.
They had to prioritize sales pace over maximizing price. Affordability just forced their hand.
So let's drill down a bit on that Q4 performance. The year-over-year context really shows you how tough it's been.
Absolutely. Q4 revenue was down 15% year over year from $2 billion. And the GAAP EPS, the non-adjusted number, was $1.55.
Which is way down from $2.52 the year before.
Right. And for the whole fiscal year, revenue finished at $6.24 billion, which is down 10%.
And that profitability issue, it's everywhere. Besides the lower gross margin, the home building operating margin got squeezed.
Squeezed hard. It landed at 6.9% versus 11.5% the prior year.
It just speaks to this loss of efficiency.
It really does. And management tried to soften that, which is why they led with the adjusted EPS, that 192 number.
Right. They pointed out the exclusions.
Yeah, they said the adjusted number excluded about $13.7 million in inventory charges and another $16 million in accelerated equity comp. Their reasoning was it provided a, quote, like-for-like number.
So basically, we hit our goal, but we had to take these charges to clear the decks.
That's it, exactly. That's the cost of the cleanup we mentioned. They're strategically clearing out that older, higher-cost spec inventory that's been sitting on the books.
The stuff that built up when supply chains were a mess.
Precisely. They're paying a cost to transition.
So what about the actual demand? I mean, with affordability being such a huge issue, were people still buying?
And, well, they were. Net orders in Q4, they came in at 2,414.
Which is down, but not catastrophic.
Down about 10% year over year, which, in this rate environment is pretty respectable. Cancellation rate held steady at 18%.
And the absorption pace?
3 sales per month per community, which is pretty steady for what's usually a slower quarter. Their backlog is still solid, too. About 3,100 homes valued at $1.4 billion.
Okay, but to their credit, they did highlight some success on the cost side, controlling the controllables.
That was a real bright spot of the call. A huge focus on value engineering and just process efficiency. Direct costs on homes started in Q4 were about 4% lower sequentially.
And year over year.
6% lower year over year. And that is critical because they are managing to drive down material and labor costs on new starts, which helps offset some of that relentless pressure from rising land costs.
It sounds like a good defensive play, but defense doesn't win the whole game. They need some offense.
And that offense is all about changing the product they sell.
Which brings us to the strategic pivot. Here's where it gets really interesting. The shift back to the personalized built-to-order model, or BTO.
They were very direct about it. They said affordability and high mortgage rates are the, quote, governing reality. So their solution isn't just cutting costs here and there, it's structurally changing how they make money on each sale.
And for anyone not familiar, BTO just means they build a personalized home for a specific buyer, not just building a spec home and hoping someone comes along.
Exactly. They want to get back to a 70% BTO mix, which is where they historically like to be. The supply chain chaos pushed them down to more like 57%.
And the math behind this shift is just crystal clear.
It is. Management said BTO homes generate gross margins that trend 3 to 5 percentage points higher than their spec sales.
3 to 5%. That is a monumental cushion in an environment this tight.
It is. And the reason why is really a two-part benefit, isn't it?
It is. First, the design center. When a customer customizes a BTO home, they're paying full price for all those high-margin upgrades.
Right. And second, by selling the home before you even pour the foundation, KBH avoids all the risk and cost of having to discount a finished spec home that's been sitting around for months.
Which is exactly what crushed their margins in Q4.
But BTO only works if it's fast. No one wants to wait a year.
And that's the enabler here, the operational execution. They said their build times are roughly 20% faster year over year.
That speed is the game changer. They're hitting targets of 120 days or better from start to finish on a BTO home. Think about that.
A custom home in 4 months.
Some divisions are averaging less than 100 days. That makes a personalized home competitive on timeline with a resale or a spec home. It's a huge value proposition.
And their new community strategy is built around this. They're forecasting a peak community count in Q2 of fiscal 26.
And they're using these new sites to drive BTO sales because, critically, when you open a new community, there's no old spec inventory to compete with.
So they're setting up these communities to be BTO-focused, higher-margin operations from day one. It's smart.
It removes that internal conflict of sales teams having to sell against their own discounted inventory.
Okay, before we get to guidance, we have to talk about the buyer profile. Because despite all the challenges, the buyers they are getting are really strong.
This is such a crucial data point. It tells you the problem isn't the quality of the buyer, it's the affordability hurdle.
So what do the numbers look like?
Their joint venture, KBHS Home Loans, had an 80% capture rate, and the average household income for those buyers was $130,000.
That's a very qualified buyer, not someone who's stretched thin.
Absolutely not. The average FICO score was 743. And get this, the average cash down payment was 17%.
Which comes out to?
Nearly $80,000 in cash. Even more telling, 10% of their Q4 deliveries were to all-cash buyers.
So the demand from people who can afford to buy is rock solid.
Exactly. And the BTO shift is for them. Even these affluent buyers are price-sensitive now and want that customization and value.
And while all this is happening, they're shoring up the balance sheet.
Yep. Upsized their credit facility to $1.2 billion, extended it out to 2030, extended a term loan, too. They have plenty of liquidity.
And they showed some real discipline on land.
They did. They control about 65,000 lots, but 43% are through options, which is very capital light.
And they walked away from bad deals.
Critically, yes. They canceled contracts on 3,500 lots in communities that just didn't meet their new underwriting criteria anymore. That's great capital stewardship.
And finally, they're buying back their own stock. Aggressively.
$100 million in Q4, bringing the fiscal year total to over $500 million. And they authorized a new, massive $1 billion repurchase program.
So they clearly think the stock is cheap.
They do. So what does all this mean for the near future? This brings us to the guidance and the reason the stock pulled back, the margin trough.
Yes. Management guided Q1 housing gross margin down to a low point of 15.4 to 16%. That sequential dip is what spooked the market.
And they said it's primarily due to two factors. First, seasonality. You just have lower revenue in Q1, which creates negative operating leverage. Fixed costs hit harder.
And the second factor is that cleanup bill we've been talking about.
Exactly. They are still selling off that older, higher-cost spec inventory. They have to clear it out to make way for BTO, and that clearance costs them on margin.
But they were firm that Q1 should be the bottom.
Very firm. They expect improvement all through the year, driven by sales accelerating and that powerful lift from the BTO mix kicking in.
What's the risk there? What could delay that recovery? Their optimism seems to really depend on smooth execution.
The primary risk is the macro environment. If mortgage rates spike again and derail the spring selling season, that would be a huge problem. BTO relies on getting those early sales. If sales slow, they're stuck building specs again.
Okay, so looking at the full year, what did they guide?
For fiscal 26, deliveries between 11,000 and 12,500 homes, generating housing revenue of 5.1 to 6.1 billion.
And the implied average selling price, the ASP, is higher.
It is, but they were quick to clarify that's not them assuming price increases. It's purely a mix shift. They have higher-end communities in places like California scheduled to deliver more homes in the back half of the year.
Interesting. And relative to the sector, KBH stock had actually been showing some strength against the home builder ETF, ITB, before this call.
It had, but this call definitely introduced a show me period. The market wants to see proof of the BTO pivot before it buys in.
The market is focused on the immediate pain. We are focused on the strategic buffer.
Which brings us to our
This is not financial advice's segment.
disclaimer fully delivered.
Okay, so the market is punishing KBH for this Q1 margin guide. The pain is real, driven by seasonality and clearing out old, costly spec homes. But the whole strategy hinges on this BTO pivot.
The pivot that offers that 3 to 5 point margin upside, enabled by those super fast build times.
So the setup is clear. You have macro pressure on the whole sector versus this very specific, internal, controllable, operational upside at KBH.
The opportunity is that KBH could decouple from the rest of the pack.
So the outrageous but plausible trade idea is a relative value trade. Go long KBH and short the home builder ETF, ITB.
It's a bet on idiosyncratic risk. A bet that KBH's internal strategy can trump the sector's general sensitivity to interest rates.
Precisely. The whole sector faces rate volatility. But KBH has this powerful internal catalyst in the BTO margin uplift that its more spec-heavy peers just might not be able to replicate as quickly.
So we're basically buying the dip caused by this necessary inventory cleanup.
Exactly. We're betting that the structural improvements they've made will allow KBH's performance to separate from the broader sector over the next 3 quarters. It's a bet on operational execution over macro sentiment.
And the trigger to watch would be what? Q3, Q4 deliveries?
I think so, yeah. You watch the deliveries from that new BTO sales pipeline they're building this spring. If they can show an accelerating margin trend in Q2 because of those new communities, KBH should materially outperform the sector.
So to summarize this dive, the KBH Q4 call was really defined by that transition. A solid headline beat, but it's totally contrasted by the near-term margin pain they have to take to get back to their high-margin BTO model.
And that shift is supported by a strong balance sheet and a really qualified buyer base. Management has done the hard work on costs and build times.
The real question for the year isn't really about demand, not with that 743 FICO score. It's whether their operational discipline can overcome the market's skepticism about this Q1 margin trough faster than people think.
Right. Management cited a normal spring selling season as being key to hitting their guidance. So here's the final thought for you to mull over. Given all the pressures they talked about, rates, affordability, what underlying indicator outside of just opening new communities would signal that KBH's conservative guidance is actually hiding significant upside?